Hello students, I am Professor Sanjita. Welcome everyone to my Risk Management Lecture Series 8. In today's lecture, I am going to cover the following learning objectives. We'll be studying about credit derivatives. What do you mean by the term credit derivatives? The different types of credit derivatives. The first one is credit default swap, CDS. Second one is credit linked notes, CLN. And the third one is collateralized debt obligation, that is CDO. Now, let's have a look at credit derivatives. What do I mean by this and what is significant? A credit derivative is actually a financial instrument that transfers credit risk related to an underlying equity or a portfolio of underlying entities from one party to another without transferring the underlyings. As we all know that derivatives is actually a financial instrument to mitigate the risk, and if we just relate that derivative which is related to mitigating the credit risk, we see that it is a credit derivative. So simple thing is that if one person is having a credit risk and that person wants to transfer his credit risk to another person, he can take the help of credit derivatives. The underlying may or may not be owned by either party in the transaction. Now, the most common derivative that we actually use on corporate bonds are called credit default swaps. What is credit default swaps? These are the most widely used type of credit derivative and the most simplest one we can say. It is a financial derivative for contract that allows an investor to swap or offset his or her credit risk with that of another investor. It is a financial swap agreement that the seller of the CDS will compensate the buyer in the event of a debt default by the debtor or other credit event, we can say. So what is it? It is a swap agreement. Swap means exchange agreement. If suppose I am having a credit risk and I want to transfer my credit risk to another person, I can enter into a swap agreement that in case of any default, if I'm not getting money from my um, credits that was made by me to a borrower, I'm having a credit risk. So obviously, I don't want to take that risk up. So I have entered into a financial swap agreement, and the CDS seller who have given me that CDS, that seller or the party is ready to compensate me in the event of a debt default. If I am not getting my money back from my borrower, so that amount will be compensated by the party with whom I entered into the swap agreement. This is the simplest working of a credit default swap. For example, if I take a simple example, I can say that I uh, just gave some money to a person for 2 years, right? That person is going to give me the interest for the first year and the second year, and at the end of the second year, the principal along with the interest. So, for the first year, suppose that person gave me the interest, but for the second year, he defaulted. He has not paid any amount of interest, not the principal. So, I'm exposed to the credit risk. In this case, what will happen? Mm, in case of CDS, if I have entered into a financial swap agreement with another party, then that party, third party, is going to compensate me in exchange of the CDS. That party is going to pay me the interest along with the principal in place of the borrower. So the buyer of the CDS, you know, I I have entered into a CDS agreement. For example, I've stated over here. So I makes a series of payments, that is CDS fee, to the seller. And in exchange, the CDS seller agreed that in case of default, it will compensate me the money. That this is the basic working of CDS. Now, credit linked notes. It is also a form of, you can say, credit derivative. It is a form of funded credit derivatives. Now, it is structured as a security with an embedded credit default swap. That means a credit default swap is already embedded into the structured security, and it allows the issuer to transfer a specific credit risk to credit investors. Therefore, you can say that it is a structured note issued by a special purpose company or trust designed to offer investors per value at maturity unless the referenced entity defaults. In the case of default, the investors receive a recovery rate. So in case of default, what will happen? The trust will pay the dealer par minus the recovery rate in exchange for an annual fee, which is passed on to the investors in the form of a higher yield on their note. This is credit linked note. Now I move on to the next very interesting topic, that is collateralized debt obligation, that is CDO. What is it? It is also a structured financial product that pulls together cash flow generating assets and repackages this asset pool into discrete tranches that can be sold to investors. So basically, let me explain it in a very simple term. That is what happens is, suppose a bank have a loan portfolio which consists of a number of loan accounts. All of them are attached to some kind of collaterals or securities. So the bank what is does it pulls all the assets together. That is the loan portfolio, loan assets, loan accounts are pulled together, and then they are repackages into asset pool into discrete tranches. That means they are cut into small packets with a combination of all the accounts, all the assets in it, so that the risk is diversified. The reason behind it is to diversify the risk that is connected with each package. They are cut into small packets so that their value goes down less, and so that one investor can easily buy that packet, because is usually banks have loan accounts with crores of money. They lend thousands of crores of money to customers. That is their business. So if one single investor cannot buy that, so it's cut into different small packets so that the bank can easily get investors for those small packets. Now, a collateralized debt obligation is named for the pooled assets, such as, you can say, mortgages, bonds, and loans, etc., that are essentially debt obligations that serve as collateral for the CDO. Now, the tranches in a CDO, they vary substantially in their risk profiles. right? Different strangers, that is different packets, they vary in their risk profile. Some have more risk with a greater return, whereas some has a less risk with a less return. The senior tranches, they are divided into senior to junior one. So the senior tranches, they are generally, you can say, they are safer because they have first priority on payment from the collateral in the event of default. So in this way, the different tranches are classified into senior, then next senior, then junior, like this, according to their risk profiles. So that's all for CDO. The investors come and invest in their money, and what happened? The bank actually gets back all its payment from the investors. It raises the payments, raises in the amount that was equivalent to the loan that was given to the borrowers, and it is now credit risk free. And all the risks are transferred to different investors in the smaller, in the form of small packets. So, huge risk has been cut into small, and they have been transferred to other customers or investors who bought the packets from the bank and invested their money. In case of any kind of default, what happens is that the investors suffer that risk. They take up the risk, so definitely they will suffer. But again, some amount is compensated from the bank, and they get back their recovery rate. This is how credit derivatives can be utilized in the form of credit default swap, that is CDS, then credit linked notes. We can also use CLN, and then collateralized debt obligation. So these various kinds of credit derivatives can be used by any person or organization in order to mitigate their credit risk. Now, that's all for this today's lecture. In the next lecture, I'm going to cover the meaning of operational risk. Now we are going to start a new kind of risk. We're going to throw some light on the meaning of operational risk, types of operational risk and its identifications, then drivers of operational risks, and the different levels of operational risk management. We will see what are the different levels at which the operational risk actually lies. So all these things will be covered in the next lecture. Thank you all the viewers for today's session. Thanks a lot. See you all in next lecture. Thank you all.